For 80 years, American superpower status rested not solely on military might, but on the singular financial privilege of printing the world's reserve currency. We freely exported domestic inflation while the rest of the world dutifully imported our debt, effectively funding massive deficits with global savings. That era of free lunches quietly ended on January 5, 2026, a date future economic historians will mark as the start of the Great Financial Repression. A routine US Treasury auction for 10-year notes failed spectacularly, with demand collapsing to historic lows as international buyers demanded steep discounts to participate. The primary dealers were left holding billions in unwanted paper because the traditional, reliable giants of global finance have exited the American bond market. Japan is no longer buying dollars. The Bank of Japan is actively selling its treasury holdings to desperately defend its own collapsing yen currency. Beijing is accelerating its de-dollarization strategy, dumping American financial assets to secure hard resources, energy reserves, and gold across the global south. Even the petrodollar arrangement has dissolved, with Saudi Arabia now accepting yuan for oil transactions and reinvesting surpluses domestically instead of in U.S. debt. This foreign exodus leaves the U.S. Treasury and the Federal Reserve facing a terrifying mathematical abyss regarding immediate fiscal solvency. The federal government needs to borrow approximately $3 trillion this fiscal year just to maintain basic operations and service existing debt interest payments. Without this massive influx of new capital, government checks will bounce, federal operations will shut down, and the global American empire ceases to function. The Federal Reserve cannot simply print this amount without triggering catastrophic hyperinflation that would instantly destroy the dollar's remaining domestic credibility. Commercial banks are also unavailable, currently too choked with massive commercial real estate losses to absorb another multi-trillion-dollar deluge of government paper. There remains only one pool of capital large enough, liquid enough, and compliant enough to absorb this toxic debt: your personal retirement account. They are targeting the $35 trillion sitting unguarded in American 401ks, IRAs, and defined benefit pension funds as the new funding source. The government has initiated the GRA Mandate, a protocol designed to nationalize your savings not through direct seizure, but through subtle regulatory capture. They are quietly rewriting the rules of ERISA, the Employee Retirement Income Security Act, to turn your nest egg into the buyer of last resort. Your safe bond funds and target date vehicles are being transformed from investment tools for your future into conscription notices for a financial war. This marks the end of free capital markets and the beginning of financial repression, where citizens are forced to fund bankrupt governments at negative real rates. Unless you understand the mechanics of this regulatory trap, you are destined to become the bag holder for the greatest sovereign debt bubble in history. How does a government force 100 million free citizens to purchase a depreciating asset that the world's savviest investors have already rejected? They do not send armed agents to your door. Instead, they weaponize a single, comforting word that shuts down critical thinking: safety. The true mechanism of this control is not the Securities and Exchange Commission, as many assume, but the Department of Labor. The Department of Labor administers ERISA, the federal law that governs the vast majority of corporate retirement plans in America. At the heart of ERISA lies fiduciary duty, a legal obligation requiring plan administrators to act strictly in your financial best interest. Historically, best interest was interpreted as maximizing investment returns for a reasonable level of risk to build your wealth. However, in the last 72 hours, a new guidance memo has quietly circulated through the compliance departments of BlackRock, Vanguard, and Fidelity. This document fundamentally redefines fiduciary duty for the volatile geopolitical landscape of 2026, shifting the focus from growth to preservation. The new guidance argues that in an era of global conflict and trade wars, holding high percentages of equities is now legally imprudent. It suggests that a responsible fiduciary must now shelter client assets in the only vehicle defined as risk-free by federal law: US Treasury bonds. This creates a flawless legal trap that insulates asset managers while condemning your portfolio to guaranteed stagnation. If a manager keeps you heavily invested in the S&P 500 and the market corrects due to war, they can be sued for reckless negligence. Conversely, if they move your money into treasuries and you lose purchasing power to inflation year after year, they are completely immune from liability. They can simply claim they followed the federal safety guidelines, creating a perverse incentive structure where managers fear lawsuits more than they fear your poverty. Consequently, We are witnessing a mass rotation of capital where fund managers are dumping high-performing corporate stocks to buy government debt. They are selling shares of productive American companies like Apple and Microsoft to purchase the very bonds that Japan and China refuse to touch. The primary weapon for executing this theft is the target date fund, the default investment vehicle for millions of passive 401k holders. These funds operate on an auto-glide path, theoretically shifting you from stocks to bonds as you age to reduce volatility. My analysis indicates the government is pressuring providers to aggressively accelerate these glide paths under the guise of volatility protection. A worker retiring in 2040, who should have 20% bond exposure, is suddenly being shifted to 40 or 50% without their explicit consent. This is a form of stealth capital control. You did not click buy bonds, but the algorithm quietly executed the trade on your behalf while you slept. This mirrors the controversial guaranteed retirement account proposal long championed by economists like Teresa Ghilardici, which sought to mandate government-managed savings. Realizing such overt legislation would be rejected by Congress as socialism, they have achieved the same outcome through the backdoor of compliance regulation. Your 401k is being repurposed from a vehicle for your financial freedom into a financing engine for the federal deficit. You have become a captive lender, unable to refuse the loan because the transaction is hidden behind layers of automated asset allocation. The implications for the stock market are profound. If retirement funds become net sellers of equities to buy bonds, a massive pillar of support vanishes. It signals that the government is willing to sacrifice the growth of the stock market to artificially suppress its own borrowing costs. Why go through this elaborate legal charade with ERISA and fiduciary rules instead of simply raising taxes? They are engineering a condition known as negative real yields, the only proven way a bankrupt nation can pay its bills without defaulting. This is financial repression, a tax that is never voted on, never signed into law, and never appears on your pay stub, yet is brutally effective. Consider the math of the theft. The true cost of living, food, energy, insurance, is inflating at roughly 7 to 8% annually. To simply preserve your wealth, you need an investment yielding at least 8%. Anything less is a mathematical loss of purchasing power. However, the US Treasury cannot afford to pay 8% interest on $35 trillion of debt without instantly bankrupting the nation. Consequently, they must cap yields at roughly 4.5%, creating a deliberate gap between inflation and return. In a free market, no rational actor would lend money at 4% when inflation is 8%. It is a guaranteed loss. This is exactly why Japan and China exited the room. They calculated the return-free risk and refused to play. But by mandating your 401k to buy the bond via the ERISA mechanism, the government forces you to accept the deal that foreigners rejected. That 3.5% spread is not a rounding error. It is the specific rate at which your wealth is being transferred to the state. Compounded over a decade, this mechanism quietly wipes out 30 to 40% of the purchasing power of your retirement savings. The dollar figure in your account may remain steady, but the reality of what those dollars can buy is collapsing beneath you. This subtle extraction is the political genius of the mandate. If the government raised income taxes by 40% to pay the debt, citizens would riot. But when they erode your savings by 4% annually through negative real yields, you don't protest. You simply blame greedy corporations for rising prices. It is a slow-motion default where the government fulfills its promise to pay you back, but does so in a currency they have purposefully devalued. This creates a closed loop of wealth extraction. You work, you save, your savings buy treasuries, the treasuries fund the deficit, and the deficit creates the inflation that eats your savings. The safety they are selling you is the safety of a prison cell. You are protected from market volatility, but you are not safe from the warden stealing your lunch. The situation is even more dire for defined benefit pension funds, which hold the retirement security of millions of teachers, firefighters, and municipal workers. These funds are legally required to hold high-grade debt, effectively transforming them into subsidiaries of the US Treasury under the new protocols. Pension actuaries assume a 7% annual return to pay future benefits, yet the bonds they are forced to buy yield only 4.5%. This mathematical impossibility guarantees a solvency crisis that will eventually require a Federal Reserve bailout, printed with new money that further dilutes your wealth. The guarantee in the guaranteed retirement account is simply a guarantee that you will be the one left holding the bag for the national debt. You cannot stop the government from rigging the game, but you can refuse to play by deploying what I call the Archivist's pension protocol. This is not traditional financial advice. This is a capital jailbreak strategy designed to protect your life's work from being inflated away. Protocol Rule 1 is the most urgent step you can take today. Kill the target date fund immediately. Log into your 401k portal and check your allocation. If you are invested in a retirement 2035 or 2040 fund, you are in the trap. These automated funds are the primary mechanism for bond force feeding, designed to capture passive capital that doesn't ask questions. The structure of these funds gives the manager complete discretion to shift your allocation from stocks to bonds without your specific permission. The new Department of Labor guidance is pressuring these managers to make that shift aggressively in the name of safety. You must sell the target date fund and move your capital into self-selected allocations found within your plan's menu. Even within a restrictive corporate 401k, you generally have options to select specific large-cap stock funds or S&P 500 trackers. Look for international equity funds, small-cap value funds, or anything that represents legal ownership of a business rather than ownership of government debt. In a high-inflation environment, stocks will be volatile, but they represent a fighting chance because they claim real assets. A corporation owns tangible things, factories, intellectual property, inventory, and land that naturally reprice upwards as currency devalues. A bond, by contrast, is merely a fixed promise to pay you back in the future using currency that is actively losing value. Therefore, you must exit the bond funds and reject the glide path. Seek to own the productive business, not the government's debt. If you require liquidity or safety, hold short-term cash instruments, but avoid duration. Long-term bonds are now the mathematical death zone. Protocol Rule 2 is the Bastille escape hatch for your dormant capital sitting in old accounts. If you have an old 401k from a previous employer, do not make the mistake of rolling it into your current company's plan. That is simply moving your capital from one prison cell to another. Instead, roll it over into a self-directed IRA. A corporate 401k is a walled garden where you can only eat from a limited menu of government-approved financial products. A self-directed IRA tears down that wall, allowing you to act as the true custodian of your own assets. You can use this legal vehicle to purchase physical gold and store it in a secure, non-bank depository. You can acquire income-producing real estate, farmland, or private equity that exists entirely independently of the Wall Street casino. You can even allocate to Bitcoin if you believe in digital sovereignty and want an asset outside the central banking system. The government despises these self-directed accounts because they represent massive leakage from their captive debt financing system. Protocol Rule 3 involves a critical loophole known as the in-service withdrawal. Most workers falsely assume their capital is hopelessly locked inside the corporate plan until they quit or retire. This is often untrue. If you're over age 59 and a half, or sometimes younger, you may qualify to move funds now. Call your plan administrator today and ask the specific question. Do you allow in-service, non-hardship distributions? If the answer is yes, execute the transfer immediately, leaving behind only the minimum amount required to capture the company match. Get the capital out of the captive system and into an IRA you control before the next regulatory cage lowers. Protocol Rule 4 requires you to fundamentally delete your old definition of risk and install a new operating system for your wealth. From 1980 to 2020, the financial industry defined risk simply as volatility, how much a price moved up or down on a daily basis. In that bygone era, stocks were considered risky because they fluctuated, while bonds were labeled safe because they were stable. But in this new era of financial repression, risk is defined as the permanent, unrecoverable loss of purchasing power. Under this accurate definition, long-term bonds are now the riskiest asset class in existence because they guarantee a mathematical loss. Stocks are comparatively safer because they possess the potential to outpace inflation through pricing power and real asset growth. However, the true apex of safety is now found in hard commodities, gold, silver, energy, and finite resources that cannot be printed by central banks. You must position your retirement to float on top of the coming inflation flood, rather than anchoring it to the bottom with government paper. The GRA mandate is the final, desperate move of a sovereign debtor that has run out of willing foreign creditors. Japan left the auction, China left the auction, Saudi Arabia left the auction. So the US Treasury locked the doors, turned to the only people remaining in the room, you, and said, "You will buy it." They're banking on your apathy. They're counting on you being too busy with your daily life to check your quarterly statement. They're relying on your blind trust in the word safe while they systematically pick your pocket through negative real yields. They assume you will not notice that the fruit of your labor is being stolen to pay for a deficit you did not create. Do not give them the satisfaction of your compliance. Do not let your life's work become their collateral. Unlock your capital, reject the toxic debt, and break the chains of the mandate before the lock snaps shut. The pension system was originally designed to secure your future, but it has been redesigned to secure the government's present. You cannot change the macroeconomic tides or save the system, but you can build an ark for your own household. We have identified the trap, we have decoded the mechanism, and we have laid out the escape protocol. Take back your future. This is the Archivist. The protocol is active. Class dismissed.